Now let's look at three specific variants of offers that the lending institutions make to people. And of course, we will look at it from a borrower's perspective and who can qualify and who should take that particular offering. Let's look at the bullet payment. The bullet payment actually means what it says. It's a bullet payment. It's a one-shot repayment that happens, typically at the end of the term of the loan, but can also happen during the life of the loan. So for example, let's take this situation. There is a couple or a parent and a child who apply for a loan and want a loan, say, of 1 crore rupees. They are not eligible because they cannot service that. Their joint income and the appraisal says that we can service a loan of 70 lakh rupees. So I give them a loan of 70 lakhs. You as an individual taking the loan, take the loan of 70 lakhs because you also realize that servicing a loan of 1 crore might not be possible through EMIs. So you are happy to take that 70 lakhs, but it doesn't meet your purpose. You still want that 30 lakhs to add up to 1 crore, which is the original loan that you wanted. Now, what will happen is you will tell the lending institution, or the lending institution will ask you, can you make a lump sum payment or a bullet payment or a one-time payment 2, 3, 5, 7, 10 years from now? And you might say, yes, I can. From what? From a maturing insurance policy, from a maturing fixed deposit, from a withdrawal from a provident fund, or a sale of a property. Now, once you have identified a finite source from where you can pay this, the lending institution will say, all right, we will give you that 30 lakhs and you will assign that particular asset, the fixed deposit or the life insurance policy, to us, and when it matures, that entire payment will come to us as a one-shot bullet payment. This way, the lending institution's risk is limited or is not beyond what its own capacity or appetite is. They think you're good to service 70 lakhs. The additional 30 is completely backed by a security which is in your control, has nothing to do with the inclination or ability of the customer, because it's an asset that is maturing and the full amount is coming to you. Now, what about the interest on this 30 lakhs, the bullet payment? That interest should be serviced by the customer under the bullet payment product, where what will happen is that besides the EMI for the 70 lakhs, you will also pay the interest on this 30 lakhs, and therefore that 30 lakhs bullet payment will all be principal. You therefore get your 1 crore, you're not stressed in terms of servicing the EMI, you're paying your interest on that 70 lakhs, and you're also servicing the interest on the 30 lakhs. And therefore you're getting the full 30, which is the value of the asset that is maturing 2, 3, 5 years from now. Until then, you continue paying interest on that asset, that 30 lakhs also. The next variant of that, and I'm calling it a variant, is the balloon payment. The balloon payment works on the same principle, except, and please mark this, except that in this case, the interest on that 30 lakhs is not paid or serviced on a monthly basis along with that EMI. The interest actually balloons into the principal repayment, which is again being made 2, 3, 5, 7 years from now through a particular asset that is maturing, like a fixed deposit or life insurance. However, since you are repaying the loan 5 years later, and I as a lender am also recovering the interest on that 30 lakhs in the balloon payment variant, compared to the bullet payment where the interest on that 30 lakhs was being serviced on a monthly basis. Now, because of that, the outstanding loan that I can give you on that 30 lakh asset is not 30 lakhs. It is 30 lakhs minus the interest on the 30 lakhs for the number of years for which you don't pay back that 30 lakhs. For example, if you are going to repay the loan in 3 years through that bullet payment of 30 lakhs, in a balloon payment situation, what will happen is I will remove interest for 3 years on 30 lakh rupees and bring the figure down to today's value, which might be 22 lakhs, for example. And this is purely an example, it's not the real maths. Therefore, you will get your original 70 lakhs, but because you're not servicing the 30 lakhs which you're making as a bullet payment, and you're ballooning that payment into a bullet at the end of 3 years with the interest, you will only get 22 lakhs more, and therefore the total loan you will get is 70 plus 22, which is 92 lakhs, as compared to 100 lakhs or a crore in the bullet payment scenario. This is good for the borrower who cannot even service the interest on that 30 lakhs and only can pay EMI on 70 lakhs. However, if you can service the interest, then of course you get the larger amount, the full 30 lakhs more as compared to 22 lakhs, because there is no ballooning of the interest on that 30 lakhs, and that 30 lakhs is actually a repayment of the loan itself. The advantage of this product is that without stressing your servicing capacity, you get the loan that you want. The advantage of the product from a lender's perspective is that he is not exposing the risk on the customer by working a scheme out where the customer is not able to service the monthly installment by the sheer ratio of the installment to the income, and yet the customer gets his loan, and the borrower is therefore happy to go home with the full loan of 1 crore in a bullet payment, or 92 lakhs in the case of a balloon payment. In the bullet payment, he will service the interest on 30 lakhs. In the balloon payment, he will not service it, and that's why there is a reduction in the amount that is paid at the end of 3 years compared to what he gets today. 30 lakhs versus 22 lakhs. As a customer, of course, if you have a maturing asset which is maturing in the next 2, 3, 4, 5 years, you should opt for that product and talk about it with the lending institution. The reason I'm saying 2, 3, 4, 5 years is because if the asset is maturing, say 10 years from now or much later, or even 7 or 8 years, then the amount of interest that will be taken out of the balloon payment is so high that the current value of that might not be worth taking a loan more. You might, for that 30 lakhs, you might only get 5 or 6 lakhs because 24 lakhs is the interest for that 10 years. Then you might as well go for a bullet payment and service the interest. But the downside is that you'll have to service that additional interest on 30 lakhs for that full period of 10 years until you actually make the bullet payment. Let's move on and talk about bridging loans. As the name suggests, a bridging loan is a loan that bridges two events. And what are those two events, and why and who should take that is what our next segment or next capsule covers. So for example, somebody is buying a house which say costs 1 crore of rupees, and he's taking a loan of 40 lakh rupees, and he's eligible for it, and therefore the lending institution commits that yes, they will give him 40 lakhs subject to legal and technical. But he still wants the balance 60. And why does he want that balance? The reason he wants it is because his own contribution, which is that 60 lakhs, the cost of the house minus the loan amount of 40, is coming from the sale of his old house. It's a situation that you as a borrower have often been exposed to yourself, or you've heard people who are in that kind of a quandary. What will happen is that you have a house which is selling for 60 lakhs. You want to sell it, put it into the new house, and take a loan of 40 and buy a house which is worth 100 lakhs or 1 crore of rupees. But you can't sell the existing house today because the new house is still to be identified, and if it's under construction, then it is not going to be ready to live in. So where will you live if you sell the old house and don't have the new house to move into? You go into the lending institution and tell them, yes, please give me a loan of 40, thank you very much, but now I want a bridge loan of 60 lakh rupees. So the lending institution is going to turn around and think, but he won't be eligible for 60 lakhs because he doesn't have the servicing capacity. Very true. So what does the borrower then offer, or what does the borrower then counter that with? He says, I will give you the mortgage of my old house and you give me the 60 lakhs in addition to the 40 or some combination, and when the old house is sold, which is say within 3-6 months of me moving into the new house, I will sell the old house and repay the full bridging loan of 60 lakhs, keep servicing the 40 lakhs which you have given me as a normal 15-year loan. The lending institution wants to ensure that the old house will realize that 60 lakhs that it needs to repay this bridging loan. So they will do two things. One, they will value the property, that old house, and ensure its value is at least 60, in fact with some additional margin or buffer. Second, they will take the right to sell it in conjunction with the customer, so that the customer cannot say, I didn't get a buyer. The third thing they will do is, of course, they will take mortgage of the old house also, because they are giving a loan against that property in addition to the mortgage of the new house, because that is where they are giving the 40 lakhs EMI 15-year loan. When the new house is complete and the customer has moved in, he takes the full disbursement of the 40 lakhs also, taken the 60 lakhs of bridging loan, continues to pay the EMI on 40. Within a period of typically 3 to 6 months, that old house which has now become vacant is sold, the 60 lakhs is repaid, and then the loan outstanding comes down to the 40 lakhs that was given as an EMI. Customer is happy, he got the bridging loan. The lender institution is happy because it's got its 60 lakhs back. It earned interest for 60 lakhs during the period that the house was not being sold. In fact, the customer should service that interest. He not only have to pay interest on the 40 lakh loan that he is taking through the EMIs that he will pay, but he also has to pay simple interest on the 60 lakhs that he is now taking as a bridging loan. The bridging loan concept is a very focused and a very niche product which works for people who actually need this loan to bridge the old sale and the new purchase. Some lending institutions will offer that, some might not, and you as a borrower should look at it before you finally choose the lending institution you want, because a lending institution might give you the 40, in fact might give you more than 40, maybe 45, but if you are not getting the bridging loan and you need it, you are going to be stuck for paying your own contribution, which is locked in the value of the old house, which you cannot sell today because the new house is not yet ready.